following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday, and we're going to be talking about money. You know, the 4th of July weekend is a food consumption weekend. Let me give you some facts. $6.77 billion will be spent on food just for this weekend. There'll be 150 million hot dogs eaten during this weekend. 190 million pounds of beef will be purchased during the week leading up to this. And 700 million pounds of chicken purchased on the week leading up to this weekend. It's the largest beer drinking weekend, or beer drinking day of the year, July the 4th. Highest beer drinking. I've heard that that's $1 billion of beer that will be consumed this weekend. Aren't you happy to know that? 65% of people will do a barbecue on the 4th of July weekend, all celebrating Independence Day. And talking about Independence Day, there's another nation across the pond that had a big vote recently, Brexit. A week ago today, the results were in, the market dropped over 600 points, and that was followed by Monday with another 300-point drop. We haven't quite recovered yet. We will. It was a surprise to me. I thought that they would vote to stay in, and yet once they voted to move out, I think it's more than just anger. There's a lot of people that talk about the anger in Britain and the anger in the U.S., but I think it's more than that. While the young people were the ones that mostly voted to stay in, it was the older people that voted to move out. And I think there's some reasons for it. I think it's been building, and it has more to do with what's gone on than just being angry. And I'm going to talk about that later in the program. Also, the market. What's going on? We've been in a flat market for over a year. We have not seen a new high. I think I've got some ideas. You know, they say the market is driven by fear and greed. I think there's a third thing that the market is experiencing right now. We're going to talk about that later in the program, so stay with me. But first I want to talk about this whole thing with Brexit and the drop and what happened there. It was big news, and I understand that it's really big news. I think that if you look at it, we can trace a history that actually I've been talking about since 2008. If you go back and look at what happened, we had the Great Recession that happened. It happened in the U.S., it happened across the world. And back in 2008, 2009, I made a comparison. If you look at history, you can look at what was going on in England and France. They'd just come through three great wars. Their debt had exploded during that time. That's how they paid for the military equipment and the soldiers and the whole thing of those wars. They had a debt that was higher per capita than we had in the Great Recession or leading into the Great Recession. To finance everything, they had borrowed money. There were two approaches to taking care of that because the governments had run out of the ability to borrow. They'd started borrowing money from the Belgians, from the Italians, from the other countries, and the royalty in other countries. They'd started borrowing at 5%, and interest rates at the end were over 10%. So they chose to do two different things. France chose to do the stimulus side. England chose to do the austerity thing. France, under Louis XIV, Louis XIV, decided to print money. Actually, he didn't print money, but he went about it in essentially a way that is essentially the printing of money. He couldn't borrow with the existing debt, so what he did is he gave all the bondholders, essentially the bondholders, he gave them a haircut. So, for example, if somebody had the equivalent of $10,000 in bonds, he said, I'm only going to pay you $8,000, and I'm not going to pay you the 10% interest, I'm going to pay you 7%. And I'm going to issue you new bonds for that. And that's what he did. And once that was complete, he was able to go out and borrow again. And he borrowed again at 5%. And as time went on, he did that again and again. And that money was the money that came in to build chateaus, castles. It went in to build infrastructure. It went into keeping people going. And if you look at what happened at the end of that time, some people lost their heads over the whole situation. It became a very extravagant affair. And France, like we did with the Great Recession, came out of that in a few years. England, on the other side of the channel, they decided to take a different approach. They took the austerity approach. They decided to pay down their debt by cutting the social services, by cutting the safety net, by reducing government payments. Instead of giving haircuts, they honored the debt that they'd run up, and they began to pay it off at face value. But whereas France recovered very quickly with their stimulus and went on to actually build, I talked about the mercantilism in previous programs. Louis XIV brought in Jean-Baptiste Colbert, and they went through this whole process of building industries and building trade and doing all those things. That was the French approach. The English shrank into themselves, and instead of recovering quickly, it took several decades. They recovered. Both countries recovered. France recovered much faster. England, on the other hand, took decades. Decades. Think of what that would be like in our time. Decades to recover. Years and years like 2008, one after another. 20% unemployment. Tough times. People starving to death. Remember, that was followed by Malthus and his economic philosophy, that actually it was a good thing if people died because there'd be more food for those who were left. That was the time that they went through. And in both countries, people had no choice. Whereas in Britain, we just had the Brexit vote, people had no real voice. The king did it. When they asked Louis XIV what he was doing and why he was giving a haircut to the bondholders, they said, "How can you do it?" He said, "He can do it because I'm the king." That's the reason. That was the same reason in England, why they could cut that back. So I painted that picture, and I've been painting that picture since 2008 because it came into play. As we went through the Great Recession, if you look at the three areas in the Asia, the U.S., and the Eurozone, if you look at that, it was China that actually, and China and India, they actually stimulated their economy even more than we did in the U.S. But the U.S. did a lot more than the Eurozone. The Eurozone realized, and having had come through a number of times with financial crises, they realized that they needed to stimulate. But once they went through the initial stimulation, once they pumped the first amount of monies into the economy, they didn't do a QE1 or a QE2, QE3. They decided they needed to cut back and reduce their deficits. And there were some reasons beyond the U.S. You know, we went through the pigs, Portugal, Ireland, Greece, and Spain. The focus was on reducing their government obligations. So there were some reasons to do that as well. But they went through austerity. That plays into this whole Brexit vote. But there's something else. when you look at the people and how they voted, the younger people tended to vote to stay in the EU. The older people tended to go out. But remember, the older people grew up at a different time. They grew up when the sun never set on the British Empire. You had the UK, their empire, the British Empire was Canada, Australia, India, Hong Kong, and all their colonies in between. The sun never set on the British Empire. They were as the United States grew out of the 1900s, that 20th century, Britain was the second largest economy in the world. Everybody listened to Britain. Remember, Churchill and Roosevelt divided the world in after World War II. Britain had a lot of power. And we're coming to a commercial break, so don't go away. I want to finish this thought. We've got a great guest for you today. And I do want to come back and talk about what's going on in the market. So don't go away. I'll be right back after this commercial break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our clients' interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I've been talking about Brexit and what went on. I think it's more than people just angry to be angry. I think there's a lot of factors that led up to it. I talked about the austerity versus stimulus. Now, the UK was really coming out of the Great Recession in 2010. They were recovering better than we were. And we were coming out pretty well. Remember, the stock market was doing almost to new highs. My clients were at new highs in 2010. But the Brits decided that they wanted to go the austerity route. They'd done some stimulus. In 2010, they decided to cut their budget by 25%. They decided to lay off 40,000 government employees, and that had a negative impact. By the fourth quarter of 2010, they did that. In the summer of 2010, by the fourth quarter, they had gone into a double-dip recession. So you had this whole thing where they were recovering. People understood that. But then you go into this austerity type of thing where you start unemployment going all over again. Now, so that's a factor that I think plays into the Brexit vote. The second factor was the British Empire. The sun never set on the British Empire at one time. It was a powerful, powerful nation. As the United States came out of the 19th century and we led the world in industrialization, we went through that period of time that I've talked about of the super cycle from 1870 to 1907, when the U.S. moved from an agricultural nation to an industrial nation. Britain, prior to that time, was the most powerful country in the world. The sun never set on Britain. And what's happened is that Britain is now the fifth largest economy. They trail the U.S., they trail China, they trail Japan, and Germany. They're not the greatest power in the world. They don't have the impact. And by joining the common market, now the Eurozone, what happened is they lost significant influence, not by joining the EU, but a lot of people see that as part of the evolution, which brought them down in stature. And when you listen to people talk about the unelected bureaucrats in the EU setting policy, part of that is because the Brits had lost some of the power because of their economy. The third factor was the immigration factor. We talk about immigration here with the illegal Mexicans, with the Syrians coming in, but for the Brits, it's a very, very different situation. They had faced immigration since Roman times. The Romans came at the 2,000 years ago, and the Romans, 400 years later, were followed by the Germans, who became essentially the English people in the UK. The Romans probably went back to Rome, but the Germans came and settled. And that was followed by the Vikings, and eventually the biggest immigration came in 1066 with William the Conqueror and the Norman Conquest. So you had that immigration, but by the time the British Empire was beginning to roll along, you had a net emigration. You had more Brits that were leaving the British Isles than were coming in. And that continued until the mid-'80s. And in the mid-'80s, when the borders opened with the Eurozone, what you began to have happen was the immigration began to outweigh the emigration. So you had a net increase with people coming from other countries. And that was accelerated when the Iron Curtain fell. You had a huge number of people starting to migrate from Poland into the UK. From 1993 until 2014, the number of expats, the number of people that had come into the UK increased from 3.8 to 8.3 million people. 5.5 million additional immigrants into the UK. In a country of 64 million roughly, you had 8.5 million immigrants in that country. Think of it in these terms. In the U.S., if we had an equivalent number of immigrants that had come into the country in the last 20 years, we would have 40 million people that had immigrated into the U.S. Maybe 45 million or 48 million or almost close to 50 million when you do the numbers. It had happened a long time before Syria. It was that whole process. And as they went through, all these factors began to combine together. There was this feeling that the immigrants had come in and had taken away the jobs from the Brits. The austerity had thrown people out of work. And then you throw in the factor of China and China's expansion, overexpansion in steel and aluminum and whatever, putting pressure on. The two biggest steel mills in the UK shut down. There were people that wanted the government to go subsidize the steel so that people didn't lose their jobs. All that's going on. And 77% of the people felt there was enough immigration, they should shut down the borders. So all of that comes together. Not unusual, that's all those factors figured in. So when Cameron decided to do the vote, it was very close. But those people that remembered the British Empire, that had gone through the austerity programs, those people that had lost their jobs, even if they were employed, those people remembered a time when Britain was great and was, if not the greatest country, at least the second best in the world. That, I think, had a lot to do with what happened with that vote. You know, the U.S. experienced some of those problems too. Remember where we were in 2011? Remember? The market had bottomed in 2009. The economy was beginning to recover. But remember Occupy Wall Street? And remember the frustration of the young people? The students who were graduating couldn't find a job. The students that were moving back with their parents. The students that had loans but no jobs to pay off the loans. There was a concern for a double-dip recession. We didn't go into a double-dip recession, but there was a lot of concern about that. There were a lot of uneasy feelings in 2011 when you think about it. Those feelings are the same kind of feelings, I believe, that led to Brexit. How is that going to turn out? That's coming later in the program. I'm going to talk about some of the impact of what Brexit was like. But before we get to that, I want to introduce my guest today. A very interesting story. Matt Oppenheimer from Remitly. Welcome to the program, Matt.
Thanks, Mike. Great to be here.
So why don't we start with your background?
Yeah, sure. My background is fifth-generation Idahoan. Grew up in Boise, Idaho, which to some Seattleites' dismay, I clump into the Pacific Northwest. Lived on the East Coast for about 8 years, then lived in London for a while. And most recently, I was running mobile and internet banking initiatives for Barclays Bank Kenya, based out of Nairobi, Kenya. And that's where the idea for Remitly came from. And I moved back about 5 years ago to start this business.
So let's talk about Remitly. What does Remitly do?
Yeah, so Remitly is a mobile phone alternative to Western Union or MoneyGram. It enables people that move to the U.S. to send money back to their home country in a more affordable and more convenient way.
So you say send it back to their country. So it's not set up to move money from Seattle to San Francisco.
That's correct, yeah. We really focused. There are quite a few different companies that are disrupting payments kind of across the board. And there's a lot of domestic payments companies out there like Square Cash or Venmo. What I saw as a big opportunity, and I would argue is actually even a much bigger pain point when I was living in Kenya, was I was getting paid in pounds, living in Kenyan shillings, and then eventually had to get money back to U.S. dollars. And I found that process expensive, inconvenient, all the things you think of. But even more importantly, I saw how difficult it was for my Kenyan friends to get money back from their loved ones in the U.S. or Europe. And a lot of them picking up cash. It was the kind of Western Union way of doing things. That's a big, big pain point for people. So that's what we focused on, is that international money transmission segment, and it's been going really well for us.
So let's talk about the international money. What kind of volume are we talking about?
Yeah, so we are transferring over $1 billion a year now, which is up year on year. Over 400%. And so...
No, that's Remitly. But in terms of the total amount that's moving...
Yeah, the total amount, it's amazing. It's a great question, Mike. Over $588 billion is sent every year, and that's all. The World Bank tracks this very closely. And that is multiples larger than things like foreign aid. And so while not everybody sends money, those that do send money, it's a sizable part of the population in the U.S. and in other developed countries. It's a big, big part of why they moved to a developed country, and because of that, it's $588 billion. It's a huge number.
So, for example, they work here and they send their money back to the Philippines or to Mexico, or
exactly, yeah. And the ones you mentioned, it's interesting. The vast majority is sent between fewer, larger corridors, which means from country A to country B. And so, if you look at the $134 billion that comes from the U.S., which is the largest send corridor or send country. Over half goes to just 5 countries, the ones you mentioned: Mexican Americans, Filipino Americans, Chinese Americans, Indian Americans, and Vietnamese Americans send half of that $134 billion back every year.
So that's $134 billion that leaves from this country and goes to there.
Exactly.
And how much comes the other way? We're going to come back and talk about how much comes this way, how much goes that way, but we're coming to a commercial break, so don't go away. Very fascinating thing going on with this money movement. So don't go away. We'll be right back after this commercial break.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Answer. About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I'm here with Matt Oppenheimer of Remitly. We've been talking about money movement from the U.S. to other countries, actually from developed countries to emerging countries. So how much is the total amount that's going from developed countries to the emerging nations?
Yeah. So, a lot of folks assume it's kind of evenly distributed, but 435 billion of the 588 billion goes from developed countries like the U.S. and Europe to developing countries. And that's really because you think about, a Mexican-American immigrant that moves to the U.S. or a Philippine immigrant that moves to the U.S., largely part of the reason they move to the U.S. is so they can support, they have higher earning power so they can support their families back home. And that money goes an extremely long way. And that's why it's the vast majority of remittances that are sent.
Same thing was happening in Britain with the Brits sending money, or the Polish sending money back to Poland, the Greeks sending money back to Greece. So it's something that's happening worldwide.
True. Yeah, the UK, one of the larger markets from the UK is UK to Poland, absolutely.
And so you compete with people like Western Union?
Yeah, we compete with, it's actually a very fragmented market, but we compete with Western Union. They have about 17% global market share. A lot of people assume they're dominant. They have 17% global market share. MoneyGram has about 5%. And then there's a lot of other kind of local, players. But yeah, we're competing against the kind of cash-based, remittance player and bringing a digital option that is much more convenient and more affordable.
And probably more effective. I had one instance where I sent money to a partner via Western Union, probably 10 years ago. He had lost his wallet and needed money, so he was a partner in another business, so I sent him $300. He had moved on by the time the money was available to pick up because there was a screw up in Western Union. I still haven't gotten my $300 back. I got paper that the money was finally abandoned by Western Union 10 years later.
Wow.
And I paid $30 or something like that to do that.
Wow. That is an amazing story. And that's exactly right. Those are the kind, the kind of transactions that we're helping with. It's now, international. There's still a lot of customers that face the pain point that you talked about. And that's exactly the customer experience that we're making a lot better.
So when when the people send money, they go to your app, they sign into the app, and then they send it to their relatives or their family or whatever in the developing nation.
Yep.
So where do their family or their relatives or their friends pick up the money?
Yeah, so building an international network is something that we've spent a lot of time, building out our own proprietary network. So what customers do is they link their bank account or their debit card in the U.S. or now Canada, and then they can send to this proprietary network that we've built out of 23,000 cash pickup locations. Because a lot of customers want cash, often don't have bank accounts. Or if they do have a bank account, then we've also integrated with a bunch of banks in these countries where our network allows us to deliver to bank accounts within minutes as well. So either cash pickup or bank account, the sender can choose how they want the receiver to get the money.
So with what's going on in the world today, with ISIS and so on, how do you control who sends the money and who they send it to?
Yeah, so coming from banking, and I co-founded the business with a guy who's a very, very strong product co-founder, but I came from the financial services world. And coming from that world, compliance is something that we've taken very, very seriously from day one. So the first thing is we are regulated as a money transmitter in each individual state in the United States. And so we've acquired all of those licenses and take that very, very seriously. And what our state regulators require us to do, but really, quite frankly, what we, I think, have built in terms of just industry-leading systems, because it's something we care about a lot, is making sure that we know our customers. So our customers have to provide information about themselves so that we can do what's called KYC, Know Your Customer. And then we're doing a lot to make sure that we're tracking and screening and preventing our platform from being used by any sort of nefarious actors. And that's something that, because we've invested a lot in from day one, I think is something that we've built from the ground up to be really industry leading.
Know your customer is also, we deal with a lot of money as well.
Yeah.
And that's one of the key things that we go through a lot, is to know our customer as well.
Exactly. Yeah, you can relate. It's very important.
And how do you control the back end then?
Yeah.
That's where you're sending the money to.
Yeah, exactly. What I always talk about in kind of all aspects of our business, and this, dealing with money as well, is that fundamentally the thing that matters the most for customers is trust. A lot of people think it's fees. A lot of people think it's speed. Those things for sure matter. But if you don't have a trusted relationship with customers, they're not going to trust you with their money, and I wouldn't. And so I think that from our perspective, we talked about the compliance side, but there's a whole bunch on the security side, both making sure that customers' information is secure and investing a lot in our platform to make sure that we've architected it and invested in our platform to make sure it's secure. And then also making sure that we're putting in not only the compliance checks, but also a lot of the other fraud prevention checks, such that our platform's not being used by any sort of nefarious actors. And we do that while maintaining a great customer experience, because that's really important. We don't want to treat our good customers like they're bad people or bad nefarious actors. And so the way we've built our platform, I think, does that very well.
And cybersecurity is one of the big issues as well in today's world. We've gone through the people that try to hack us every so often. I'm sure that you experience the same kind of things. So how are you equipped that way?
Yeah, I think it's been core to our strategy from day one to hire the right people, architect the system. You can leverage a lot of existing as things continue to evolve. You can have Amazon-like security and infrastructure by leveraging some of the infrastructure that they've built and using things like AWS. And I think that that's been a priority for us from day one. And it's been, even if you think, we focused just on the U.S. to the Philippines for several years. We've been at it 5 years now. We're now in other countries, and we just raised almost $40 million to continue to expand. But it ties back actually to your security question, because I think a lot of companies out there try to go really broad, really fast. They're focused on the vanity metrics. They're focused on the wrong things. We focused on getting the product right, which puts and security is at the top of the list there, such that we're scaling up from a much stronger base. And that is something that is how you build a big, sustainable, long-term company.
Well, it's certainly a very key company. It's key in what's going on in the world and the money transfer, and being sure that the money is transferring properly from the know your customer on this side to know the customer at the other end.
Absolutely.
So thanks for being on the program.
Thank you, Mike.
So if somebody wanted to get a hold of you and use your app, how would they do that?
Yeah, so they just go to remitly.com, or they'd go to the iOS or Android store, and they'd be able to download the app.
Okay. Very good. Thanks for being on the program.
Thank you, Mike.
Okay. So I was talking earlier about Brexit, and I want to shift back to Brexit because it is a number of factors that led to Brexit. The question is, what happens from here? And you hear all sorts of talk about where things are going from here. There was a column, Boris Johnson, who was the mayor of London, who at the time I began to prepare this program was probably the lead candidate to become their premier, no longer. But he said that the only thing that was going to change is they were going to be able to limit the immigration. The immigration, not the Syrian immigration, but the immigration from the other EU countries, especially the Eastern European countries. The response to that from the EU members was he was delirious, that wasn't going to happen. You either take it all the way or not at all. And I think there were a number of countries that were happy to see them go. 44% of British exports go into EU countries. And without products being able to move tariff-free, without the trade negotiations, without those things being taken care of, they're going to have greater difficulty in shipping those products into the rest of the EU. And I wouldn't be surprised. You hear France saying, we want you out. France was the country. When de Gaulle was head of France, they tried their best to keep the UK and the Britain out of the common market. If you recall that period of time, there were years in which the UK was not allowed into the common market. De Gaulle fought it hard. I think now that the Brits have taken the vote, there's going to be a big push by the Europeans to keep them out, the European Union, for two reasons. One, I think they'll be able to see that their economies will take advantage of Britain and take advantage of British exports that are going to be limited. And I think, secondly, they want to stop the whole Brexit thing from becoming something that's done in France, in Italy, and some of the other EU countries. You know, Marie Le Pen is talking about France withdrawing from the European Union. Brexit. I think that the EU will work very hard to make it very difficult on the Brits, just so that they maintain the common market, the single market, the single European Euro zone. And the other thing is Scotland wants to be part of the EU. We could very well see Scotland vote once again to secede from Britain, from the UK, and take the oil reserves into the EU and the oil reserves away from Britain. There's more to come, and we're coming to a commercial break, so don't go away. And I want to talk about what's going on in the market. It's kind of crazy. So we're coming to a break. Don't go away. We've got more to say.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I want to shift gears as we come to the close on the program. What's going on in the market? You know, of course you can say that Brexit down 600 points on Friday, down 300 points on Monday, and then the kind of recovery that we've gone through the last little bit. You can say that was due to Brexit and the nervousness about what's going on and if everything's going to recover. But we've been in a flat market. And I talked about the flat market the last couple of weeks. That market moving forward looks very positive. But what's kept it down? I believe that there's an old saying that the market is driven by fear and by greed. And I think there's a third factor that's going on now and has been going on for the last year, and that's a fear of looking stupid. You know, Adam Smith wrote a book called The Money Game, and he talked about in the 1960s, a lot of the mutual fund managers were young managers, were young, in their 30s, in their 20s. If you look at today, where we are, mutual funds control over half of the stocks in the stock market, over half. And half of the mutual fund managers are 31 years or younger. They were in college or they were in high school when we went through the Great Recession. There's a real difference in going through it when you're in school and reading about it and studying it and actually experiencing it. There's a huge difference about reading about people losing their jobs and actually knowing your neighbors who have had their house foreclosed, who are really qualified and who have lost their jobs because the company either downsized or went out of business. There's a real gut-wrenching thing when people have to come to the point where they can't send their kids to the college because they lost that money. It was invested in stocks, and the stock market has plunged 37%, and suddenly the money that was planned to go for education is gone. Or even those who had financial plans with a variety of assets, all those assets, which were supposed to balance out, didn't balance out. And whether they were down 37 or 50% or 20%, it had a huge impact. It was a huge impact to see unemployment at 10%. 1 out of every 10 people who wanted to work couldn't find a job or couldn't have a job. That kind of gut-wrenching experience is very different from picking up a school book and reading about it, or picking up the newspaper and reading about it. It's one thing to look at the news and see what's going on with ISIS and the beheadings that are taking place and the wars that are going on. It's another thing to have experienced that. Same thing with this whole Great Recession. And now you have these young Turks. And one of the things that was in the book is Smith wrote about a fictional character called the Great Winfield, who exploited kids' markets by not only hiring investment managers who were not yet 30 years of age. And the strength of my kids, he said, is that they're too young to remember anything bad. And they're making so much money they feel invincible. Now you know, and I know, that one day the orchestra will stop playing and the wind will rattle through the broken window panes, and the anticipation of this freeze the rest of us who are old enough to remember. And we are old enough to remember. The kids, it's a kids market. It's been a kids market from 2010 through 2015. And then unsettling things. The orchestra quit playing. Remember, last spring, things began to slow down. The market began to slow down. And we've gone through these jitters. And I think what's happening is these kids, and they're kids, they're 31 or younger, and for me that's a kid, they're afraid. They look at their accounts and they see that they're not performing as well as the market. And you can look at a company whose earnings come in and they miss their earnings, the estimated earnings, they miss it by 1 penny and the stock will drop 20%? Wait a minute. They were estimated to make 91 cents per share and they make 90, and so the stock drops 20%? What's wrong with that picture? They were 1% off, the price of the stock goes down 20%. Or they announce that they expect things to be slower, the stock takes a drop. It's fear, it's panic. And once they go through some of these dips, they become even worse. They get even more frightened. They've never lived through a bear market. Bear markets are punishing. You know, financial advisors get burned, clients get hurt, and people learn to stay away from taking the risk. That's the same with mutual fund managers. They learn that there's three things to know about the market. Don't lose money, don't lose money, don't lose money. And so they rest in this period of time where they don't want to look stupid. They don't want to take the risk knowing that stocks may go up and the probability is things are going to go on a plus side. They're afraid because they look at how they've done and they haven't done as well as the market. That's not a surprise. Fama and French wrote the paper, and Fama shared the Nobel Prize in 2013 showing that money managers, professional money managers, including the mutual fund managers, only 7% earn their fees. Only 7%. When you add the fees to their performance, they do as well or better. Only 7%. That means 93% have underperformance. And if you're one of those 93%, you feel the pressure. You feel the pressure that things are not going as well as you would like. Your bonus might be cut. You might have management coming around, looking over your shoulder, asking what you're doing. So you tend to do those things that make you look not stupid. You tend to buy those stocks, especially at the end of the quarter, that are safe stocks. You get out of some of the risky stuff to do the safe stuff. I believe that that's what's going on. That also says that when things begin to turn around, there are buyers. If you look at the situation right now, there's over $1 trillion of shorts. That's the highest amount of shorting that's been done in the history of the market. $1 trillion. Those people have to cover a lot of those shorts. That's a lot of buying. Secondly, if you look at mutual funds, the amount of cash being carried by mutual funds is at a level we haven't seen in decades. There's a fear. It's fear of the market going lower and the fear of looking stupid. Really, a fear of looking stupid. I believe that actually they'll look even more so when the market goes the other way, when the shorts have to cover, when the cash has to be put to work at higher prices than it is now. I believe there's opportunity for the right people to do the right thing and for money to be made. And it's not on the downside, it's on the upside. I believe that the long-term approach is the way to do the best. Fear, greed, and the fear of looking stupid. I believe those are the things that are driving the market. We've got more coming next week.
You've been listening
I will be
to
back
About
then.
Money with Mike Adams,
Have a great weekend.
a registered
Great 4th of
investment
July.
advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.